My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make a little money. My job is not to entertain you, but also explain to you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Consumers at last are finally saying no. They are pushing back on high prices. They are demanding bargains. They are mad as hell and not going to take these inflated prices anymore. This rebellion is how inflation is finally wrenched out of the system, and I bet it keeps playing out behind the scenes as long as the Fed takes its time cutting rates to ensure that prices start returning to more reasonable levels, like the levels we saw before COVID, before the supply chain mess, and some say the price gouging began. The actions of a fed-up consumer is the hidden riptide that's playing havoc with the returns of many different companies right now, to the point where we're beginning to see some actual disappointments all over the place. It impacts the averages, too, even on a seemingly sedate day. Dow dipped 57 points. S&P declined 0.16%. NASDAQ inched down 0.06%. The thing is, to even notice the pushback from the consumer, you need to piece together a ton of different data points. You have to create a mosaic by hand. Can't ChatGPT this one, because companies are reluctant to say, hey, look, we took too much price and now we're rolling it back. Sure, some you can spot with the naked eye. Last night, for example, I told you American Express had a terrific quarter. They did. Company handily beating targets, making a ton of money. But underneath, oh my, as the consumer pulled back. The sequential declines in your spending growth with the airlines. They were going at +9. Now they're only +5. Lodging, +5 down to +3. Those are staggering declines. Those are the signposts of rebellion that's coloring earnings so far. Many argue spend is slowing because we've gotten over the post-COVID revenge travel. You know what? I thought that, too. So far, the airlines blame their woes on having too many empty seats. Sure, but they could have filled those seats if they wanted to. All they had to do was slice price. However, they've been reluctant to do so after tasting that magic elixir of high pricing from extremely full planes. They must have loved that phrase every time they boarded their own planes, don't you think? Don't hear it much anymore. We know that people have clearly caught up on their post-COVID travel plans. I work for Comcast. Comcast Michael Cavanaugh talked about it on a conference call, saying, and about his theme parks, I'm going to quote here, we're down in both revenue and EBITDA when compared to last year's record performance, with 2/3 of the decline driven by lower attendance at our theme parks, end quote. Cavanaugh mentioned the culprit, calling it a COVID recovery pull forward of a magnitude we hadn't previously anticipated, hence the record theme park numbers in 2022 and 2023. But now Cavanaugh goes on to say, quote, other travel options, including cruises and international tourism, given the strength of the dollar, have experienced their own surge in demand, which caused visitation rates at our parks to normalize, end quote. I bet that Disney gives you a similar decline in park attendance. One reason that stock's falling apart, down 30 points from where it was trading when Nelson Peltz lost his proxy challenge and sold all his stock. Disney's got 5 cruise ships. I wish they had twice that many, because cruises are doing great. Maybe they could have offset whatever theme park decline we may or may not have. Remember, theme parks are not cheap to visit. I wish they would lower the ticket prices, something that everyone seems loath to do. We know tickets for events have been a huge contributor to inflation from the CPI. Suddenly, I wonder if that's about to change. Cruises are an amazing bargain. World Caribbean reports on Thursday, and it hit a 52-week high ahead of that number today. Usually, you wouldn't see that kind of strength in a stock running into the quarter, but the value advantage of a cruise is so palpable that stock buyers don't seem to mind. They don't seem to care. Plus, Carnival reported an amazing quarter not that long ago, and its stock is still roaring. The Norwegian Cruise and the newly minted Viking Holdings have been remarkable performers, too. When the cruise lines boast about their affordability, you know what they do? They compare their room rates to those of hotel rooms, which indeed are much, much more expensive. Maybe consumers aren't flocking to cruises as much as they are fleeing hotel prices, hence the sharp decline in lodging spending growth that American Express talked about. The airline stocks have indeed been clobbered. American Airlines stock is down 24% for the year because it's largely domestic and thus not getting much boost from the strong dollar. It's almost back to its COVID lows. Hey, get this, Spirit's down an astonishing 82% since its deal with JetBlue fell apart. United, Delta, and Southwest are well off their highs. I think this is, again, a sign that ticket prices got out of whack. The only way for them to take back travel market share, I think, is to offer a better price. While nobody's blinked on pricing yet, I think it could be dead ahead. You know what? I also think we can pronounce the domestic travel and leisure bull market just plain dead. And the next thing you'll see is price cuts for everything across the board involving travel. Now, we know that housing's been in a tremendous bull market because there's a home shortage. But today we saw some numbers that make me think the consumer may finally be saying no to higher home prices. Sales of previously owned homes dropped 5.4% in June compared with May, according to data from the National Association of Realtors. Inventories jumped 23.4%. Lawrence Yun, the very reliable chief economist for the National Association of Realtors, told CNBC that, and we quote, "We're seeing a slow shift from a seller's market to a buyer's market. Homes are sitting on the market a bit longer and sellers are receiving fewer offers," end quote. A buyer's market? When did you hear that last? Again, this is exactly what was supposed to happen when the Fed rapidly raised rates, but it took ages to start playing out, didn't it? As that inventory of unsold homes rises, as it grows, we could hit a tipping point where sellers finally get concerned that they may miss out on the peak. I've seen many housing cycles where everyone believes prices can do nothing but go up because we didn't have enough homes being built in the country. But housing prices, they're about psychology. As long as they're going up, everyone holds back on listing their homes. But then there's this period where transactions slow down and sellers are still holding out. They don't want to cut prices, so inventory stops moving. That is happening right now. And you know what always happens after? The inventory builds, and all of a sudden there's a panic among homeowners, afraid to miss out on those high prices. That's when they see a dramatic expansion in the number of houses for sale. It just explodes, which in turn causes prices to just plummet. No reason to think this time will be different. I think there'll be a very different view about housing 3 months from now. Look, we've now seen lots of companies with excessively high prices get a real comeuppance here. Does anyone think that Nikes are a bargain? How about a cup of Joe at Starbucks coffee? Huh? Hey, get this. How about cosmetics from Estee Lauder compared to, say, Elf? Look at the miserable numbers we saw today from LVMH, the highest-end apparel, liquor, and watch company. Sure, a lot of that was China, but there was nothing all that robust in the West to offset China. We know that the consumer's taking advantage of 3 places: Costco, Walmart, and Amazon. The first 2 have been the leaders in price cutting. The third cut prices by items by almost 20% on Prime Day, many of them over 20%. The sales were incredibly strong. That's not just frugality. That is a revolt against every other retailer that hasn't rolled back prices. Overall, I'm betting that this is not the end of the declines. In fact, I think it may just be the beginning. The consumer's at last taking action. She isn't just frugal. She's going on strike against those who haven't lowered prices yet. And she's exacting not revenge travel, but revenge against all who've kept prices high. Most important, housing prices should soon be teetering as it becomes clear that the Fed plans to stretch out its rate cuts to ensure that inflation doesn't rise from the dead, like my buddy pal friend Nosferatu. Bottom line, it was only a matter of time before the consumer finally started going on strike. And that time is now. Philip in Texas. Philip.
Hello, Jim. Thank you for taking my call.
You betcha.
I would like to know your opinion of the Wendy's company and if you feel like it's a buy, sell, or a hold situation.
I don't want to touch this Wendy's. I think it could go lower. Now, it doesn't mean I don't like the food. My wife is like, chowing down with bacon there probably while I'm doing this piece. But I must tell you that I think that Wendy's is the odd man out in this group because you got restaurant brands, you got McDonald's. Is there room for Wendy's? I'm not quite sure. Okay, it's only a matter of time for the consumer went on strike. I've been saying it was going to happen. It is happening now. And that's the best way to beat inflation. And I think we're finally seeing it occur. On Mad Money tonight, Logitech posted a beat and raised quarter last night, but the stock fell today in response. I'm getting to the bottom of it all when I sit down with the CEO. Then sometimes in the thick of earnings season, you get confused reactions to report, which actually give you a buying opportunity in a high-quality stock. I'm thinking of the situation at GM to see if that's what investors are getting here. Mattel soared yesterday on takeout rumors before falling back to earth today. I'm hearing where the situation stands with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
For months now, you know I've been banking on a personal computer upgrade cycle fueled by new AI-enabled machines. But can that carry over into everything that plugs into a PC? Take Logitech International, the leading maker of computer peripherals like keyboards, mice, webcams, all sorts of gaming gear. Last night, the company reported a nice sales and earnings beat driven by strong growth. On top of that, management raised their full-year revenue and operating income forecasts. Apparently, though, that wasn't enough to send the stock higher after management made some cautious comments about the second half of the year. And that's why I believe the stock dropped almost 3% today. Don't take it from me. Let's talk to Hanneke Faber. She's the CEO of Logitech International. Get it better in the quarter. Ms. Faber, welcome back to Mad Money.
Hi, Jim. How are you?
I am good, Hanneke. I hope you're well.
Great.
I must admit that until I read that you were cautious, I thought it was all systems go. You had a nice top line beat, a nice bottom line beat. What do you credit for the strength in the quarter?
Yeah, we had a great quarter. I'm really proud of our team's quality growth, really, plus 13% top line growth. And it was really quality. It was broad based across all our three categories, all three regions, and driven by demand, which came in stronger than we had expected. And we did all that while growing gross margins by more than 400 basis points. So that drove operating income up 67% versus last year. So just a really strong print.
Well, I'll tell you what I was confused by. You used the terms uncertain and volatile. And I believe that they literally undid all the good things that you just told. How can you have an uncertain and volatile environment and yet put up those tremendous numbers?
Yeah, the quarter was great, and we are cautiously optimistic for the future. But at the same time, we are also seeing that the consumer confidence, especially here in the U.S., is still trending down. There's still some uncertainty geopolitically. We're a very global company. So we just want to not get too far over our skis here. So, yes, we did raise the outlook to reflect the strong demand in the first quarter. And, of course, we're going to do our very best to beat that outlook further.
Well, okay, so this gets to a point that I've been emphasizing, which is the consumers growing frugal, also going on strike against companies that have raised price. That is not yours. I saw a premium Logitech gaming mouse for under $100 thanks to a Prime Day deal. How did that do?
Yeah, Prime Day, I think, was a great example of, some resilience in the U.S. consumer. We're certainly on the gaming side, we're seeing really great progress on the premium end, actually. So that gaming mouse that you just mentioned, the ProLite, the Super Light 2 is doing very well. Sim is doing very well. Our wheel racing also, at the higher end of our portfolio. But we're also seeing consumers who are a little hesitant. So it's really mixed on the consumer side in the U.S. I have to say, in Europe and in Asia, our numbers were very, very strong. Europe especially outperforming, really great consumer demand, really great execution from our team. Europe was up 20% for us. So that consumer looks even stronger.
Yeah, I'm beginning to see that dichotomy, too. It's something I want to talk about more, whether it be in soft drinks, whether it be in autos, whether it be in Europe stuff. Europe's doing better. It's something that I'm not used to seeing. But we got to stay focused on it. Now, one of the things that I don't want to overemphasize, and yet I have been, and I got to go there, what you're doing with the PC in terms of the AI PC and the AI mouse, I found very exciting. When I heard there's a $50 mouse, I toggle back and forth constantly to ChatGPT. Tell me about this, because I'll pay $50 to make it so I don't have to go back and forth and take 5 minutes of my time to be sure where I am in my PC.
Yeah, absolutely. So that's our Logi AI prompt builder. It sits in every single one of our mice and keyboards in the English language. So here in the US for sure. It comes for free. It's free software. It lets you do a shortcut to ChatGPT. It's now had more than 5.5 million unique user interactions, lots of people using it, and just a great upgrade of a product we already have with this prompt builder. We love it.
Now, Hanneke, I should not confuse that with the potential PC refresh that I think is going to be big, but there has not been, frankly, a real sign yet that there is a dramatic refresh going on.
Yeah, I would say on the gaming side, we're seeing some healthy refreshes happening of people refreshing their gaming gear, all that gear they bought during the pandemic. The gaming market is looking increasingly stronger, certainly for us. Our gaming business was up 18% in the first quarter. And again, very, very healthy. On the personal workspace side, maybe a little less so, but yes, we anticipate a PC refresh coming, and that's never a bad thing for Logitech.
Now, you've got something going for the Mac. I see Mac numbers really doing incredibly well. I don't know exactly what your ratio is, typical Wintel computer versus Mac, but is it meaningful?
Yeah, our Mac business is meaningful, and of course, generally our work with Apple is very exciting. So in this first quarter, we launched the Combo Touch for the new iPad range, and that is just a gorgeous, incredibly light product, and that's off to a great start.
What does that mean? Tell me what it does.
The Combo Touch is the cover and the keyboard that you use on your new iPad. Mm-hmm. So Apple does it, but we also partner with Apple to do it for them. Really a gorgeous product, great value as well. So if you bought a new iPad, you must have one of these new Combo Touches.
Good. I was using one Friday, and my wife says I was doing a remote hit, and I just marveled at how great the computer is. But I see the Combo Touch, and I kind of think it's pretty cool. I mean, this is just, again, part of just your continual continual new additions that you make. Will this be a holiday seller, or is it just something for school?
Both of them. So back to school is a big period for us, but the holidays as well. And as you say, Jim, I'm so glad you said it, launching 10, 11, 12 new products every quarter. That's our, motherhood and apple pie. We're really good at that. And I think what we've launched in the first quarter was strong, driving part of those results. And especially on gaming, we've got an incredible lineup of new products coming up. We're launching those on September 17th at a big global event called LogiPlay. So watch this space.
Well, that'll be ready for EA College Football 25 and then eventually GTA, which I know is going to happen someday. Hanneke Faber, thank you so much for coming on Mad Money, CEO of Logitech. Good to see you.
Great to see you. Thanks, Jim.
Thank you. Mad Money's back in for the break.
Coming up, GM has been stop and go after earnings. Ride shotgun or grab a lift elsewhere? Stick with Cramer.
At this point in earnings season, the reports are coming so fast, Wall Street tends to make a ton of mistakes. Take General Motors, which reported a healthy top and bottom line beat this very morning, only to see its stock tumble 6.4% in response. I say, give me a break. That is just plain wrong. So what the heck happened here then? GM had been on a roll, basically doubling from its lows last November to its highs last Thursday, among the best performers in the sector. That run kicked off when the company scaled back its electric vehicle investments and started returning vast sums of money to their shareholders. They announced a $10 billion accelerated buyback in November, along with a 33% dividend boost, then added an additional $6 billion to the buyback last month. Talk about shareholder-friendly. GM's results have been fantastic. 3 weeks ago, we learned that they had their strongest vehicle sales number since the fourth quarter of 2020, and it's incredible. And now it seems like the Fed will be able to cut interest rates before the end of the year. Things were definitely looking up for the automakers. This stage of the rate cycle has always been the time to invest in this group.
House of pleasure.
And that's where we were coming into the quarter. And you know what? When GM reported this morning, the numbers were they were phenomenal. And that's why the stock initially rallied in response. Wall Street was not at all confused by the actual results. The stock only sold off later after the conference call got going. More in a second. Not only did GM post a $2.5 billion revenue beat, with 7% growth, their margins came in higher than expected, and the company earned $3.06 per share. Analysts were only looking for $2.70. That's up 60% year over year. Operating cash flow and free cash flow were both substantially better than expected as well. On top of the great results, management raised its full-year forecast for earnings before interest, taxes, and automotive operating cash flow, and earnings per share. Now, get this. Previously, they had been predicting $9 to $10, okay? Now they're saying 950 to 1050. Some companies don't raise the guidance enough after a big earnings beat, but GM had a 36-cent earnings beat, so a 50-cent forecast boost is very meaningful. The new cash flow forecasts were also very impressive. I don't know how many superlatives I can put in one piece. In GM's letter to shareholders, CEO Mary Barra cited 4 key drivers of the strong performance: a high-performing portfolio of internal combustion-powered trucks and SUVs, improving electric vehicle market share, strong and stable pricing with fewer discounts than the rest of the industry, and the payoff from investments that have allowed GM to now focus more on margins and capital efficiency. As she sees it, they've got great vehicles and great execution. There was plenty of other detail in the call, with Barra getting into some of the nitty-gritty, like the features that have made her top SUVs and trucks so attractive. They got Super Cruise, named by Edmunds.com as the top hands-free driving system. She went into how they're cutting electric vehicle costs. Their best-selling model, the Cadillac Lyriq, has 24% fewer parts than the previous year's version without compromising performance. Remember, GM's on track to cut $2 billion in fixed costs this year, which is another reason for why it's just suddenly so darn profitable. Still, none of this explains why the stock got steamrolled today, does it? There was some negativity on China, where GM competes via a joint venture with the Chinese automaker SAIC Motor. Management says the competitive environment there remains very tough. Tons of startups that prioritize production over profitability. GM's trying to restructure its Chinese business to make it more efficient, but that's going to take some time. We also got a quick update on the troubled Cruise autonomous driving and business. Remember when I sat in the back on that one? Where Barra says GM's making progress with Cruise vehicles returning to the road in Houston, Phoenix, and Dallas. They're trying to reduce costs by installing these systems solely in Chevy Bolt EVs rather than developing a new robotaxi van that was part of the original plan. Again, though, most of that news is positive. It does not explain how GM stock spiked 7% in pre-market trading this morning and then suddenly got thrown into reverse. It was still in positive territory when the conference call began at 8:30 a.m. As the call got going, though, the stock started sliding lower. By the time the market opened at 9:30, GM shares were down 0.4%. And they kept falling through the first hour of trading, only finishing the session down more than 6%. So what in the world happened here then? We got to step back. I saw some people theorize that the sell was in response to the poor China numbers. No. Or the fact that GM delayed its electric Buick. No. I say those are dead wrong. Nobody thought China would be any good anyway. I don't know if Seoul is clamoring for the Buick electric vehicle. Maybe you are. I don't care. Someone else that GM, else speculated GM sold off because it's scrapping the electric van for their Cruise business. But that's a huge cost of savings. It's a positive. It's not a negative. So let me tell you what really happened here, because it's pretty darn interesting. It's a great way to look at Wall Street. At 9:04, the most influential auto analyst in America, Adam Jonas from Morgan Stanley, published a quick take reaction to the quarter, where he extolled the strength of the quarter. So far, so good. But then, without much explanation, decided this quarter would be the peak for GM. In fact, the title of the piece was called, quote, 2Q reaction, peak, question mark, end quote. In a summary, Jonas lays out all the positive. Then he suggests, history suggests the good times won't last. That was it. You gotta understand, Jonas is real good. Writes a lot. You know, kind of like, so he's like Stephen King meets Charles Dickens, this guy. But there was no real support for that argument. He's a respected auto analyst, so people took it seriously. And they, you know what they did? They ka-ching, because Jonas made you feel like maybe you're the last one in. The stock crossed from positive to negative right after that note was published and never came back. I think you could say Jonas killed GM. Honestly, if you're going to call it the peak in GM, I'd like to see a little more rigor behind the analysis. Personally, I think it's nuts to call it a peak in any automaker when there's a strong possibility that the Federal Reserve will start cutting interest rates in September, lowering the cost of financing, which matters so much to an automobile. But I don't mind that the stock got obliterated today. GM reported fantastic numbers with great guidance. And thanks to one analyst report, I almost say glib analyst, but you know what? I respect him too much. One analyst report, you can now buy it at a great price. You know what? There are other auto people besides Elon Musk. I'm watching that stock go down. Mary Barra is the one who deserves the kudos. At these levels, GM now sells for, I looked at this several times. Ben Stoto, who's our chief scientist and also research director, pointed out that this stock now sells for 4.6 times. 4.6 times. You heard that. The midpoint of management's full-year earnings forecast, making it one of the cheapest stocks in the S&P 500. That usually means it's about to roll over. It's extremely cheap, even for an automaker. Hey, maybe it's insanely cheap. Of course, there's another reason I feel confident recommending GM on this dip. This company's been buying back its own stock aggressively in recent months to the point where they had to put through another $6 billion repurchase authorization just last month. I bet they'll be in there buying the stock right next to you if you pick some up tomorrow. There's a bottom line. These busiest weeks of earnings season can cause the market to get confused about individual stocks. So don't just assume that the quarter must have been bad if you see something sell off in response. Don't presume that it's therefore the peak and it has to be all down from here. Instead, I got an idea. Do homework, see if you're getting a buy opportunity, which is exactly what I think we have in General Motors here. Cheap, but not a value trap. Instead, I see a resumption of the advance as soon as the Jonas smokescreen blows over. CEO Mary Barra goes right back in the market buying the shares of all those who are stupid enough to sell shares to the company. There. Paula in California. Paula.
Booyah, Jim. Thanks
Booyah.
for taking my call. Longtime follower, and your input and insight have changed my life financially in a very positive way.
Wow,
Thank you.
thank you. Thank you, Paula. I come out here every day, and a lot of times I think, what the heck am I doing? And I'm looking at my staff, and they're saying, what the heck is he doing? But I just feel, it's your kind of call. Then I feel like, hey, you know what? I go home and say to my wife, I say, hey, listen, it's not just the garden. I got other things cooking.
My question today is, I owned Pioneer Naturals before the Exxon buyout. I sold half and kept half. Since then, Exxon has not done very much. What should I do with my Exxon?
Okay, we're going to hold it. See, the reason why Exxon's going down and oil's going down and oil broke through the 80 level is because people remember in 2016, everyone was so excited about President Trump, who was so pro-oil, that everybody just figured they were going to drill. And that's just what they did. And all the Permian oil that came out then lowered the price of oil, and all these stocks got hurt. People think that history is going to repeat itself. I quite frankly disagree. I think Exxon is a buy. I hear music in my ear. And it's not the kind I like to hear because I got lots of good questions coming. But I guess that's the end. All right, look. In the busy weeks of earnings season, you can't always assume that your favorite stock is going down means that the quarter must have been bad. You got to cure yourself of that because it's been dead wrong when it comes to the stock of GM. And sometimes you're getting that kind of buying opportunity in a confused market. GM has actually been, I'd say there have been more peaks called in this one than there are 46 peaks in the Adirondacks. All right, much more Mad Money, including my sister with Mattel. With the toy maker releasing earnings after the bell, I'm sizing up the report and looking at the cash position, trying to figure out what the heck's going on with a buyout or no buyout or whatever. Then, earnings season really shows you that some businesses are just bad businesses to be in. I spotted one quarter of the market and I feel like I got to share it with you. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. What's it going to take for Mattel stock to get back on track? The toy makers had a tough year, and the last couple of days have been insane. Just yesterday, the stock jumped more than 15% after Reuters reported that Mattel had caught a takeover bid from private equity giant L. Catterton. But after conflicting reports that cast doubt upon that news or Mattel's willingness to sell, well, the stock fell nearly 8% today. And then tonight, Mattel reported second mixed quarter in a row, albeit with excellent margin expansion, which was enough to push the stock modestly higher in after-hours trading. So what do we do with the stock now? We went straight to the source to find out. Ninan Kreis, she's the chairman and CEO of Mattel. Take a look. Mr. Kreis, welcome back to Mad Money.
Hello, Jim. Good to be here.
Oh, terrific to see you. Now, look, I don't know how these things start. This outfit, L. Catterton, it's mostly known for friendly bids. Somehow, according to my friend Brian Sozzi, Yahoo Finance, you say there's nothing going on whatsoever. But how does something like this start? Because here we are on earnings time. We don't want to hear about a takeover bid that may not have happened.
Well, as you'd expect, Jim, we don't comment on speculation. What I can say is that we're very confident in Mattel's strategy and our ability to create long-term shareholder value as a standalone company. And turning into the quarter, you saw another good second quarter and first half of Mattel with significant gross margin expansion and improved profitability. We continued to strengthen our balance sheet and more than doubled our free cash flow in the trailing 12 months. The industry performed better than anticipated, and Mattel gained share globally in the second quarter and the first half. So we are very well positioned for the second half and look forward to a good holiday season and are reiterating our full year guidance.
Let's talk about that good holiday season. We know that stores already have to start thinking about what they're going to take. How much stuff have you ordered, and are you ordering above what you did last year?
Yeah, we do expect to grow our toy business in the second half. This year, we are prioritizing growth in profitability and strong cash generation to position Mattel for long-term growth. Following the good first half, we expect our toy business to grow in the second half with new product innovation, increased retailer support, more marketing and promotions, and new content. We expect to outpace the industry and gain market share this year and grow sales and earnings in 2025.
Now, it may not be including Barbie, though. I looked at the doll numbers, and the doll numbers were a little disappointing versus some of the other things that you're doing. And yet the Barbie, honestly, the ones that you're issuing are some of the most exciting things. And, of course, we got the movie. So, I mean, I'm wondering is there some short-term peak in dolls, and it doesn't matter what you put out because the dolls seem more exciting, entertaining, and thoughtful than they've ever been.
Absolutely. You're so right, Jim. Barbie is an incredible brand that never sits still. And the movie expanded the audience even more. Barbie was the #1 doll property globally and continued to gain share in the second quarter. This year, we're celebrating Barbie's 65th anniversary with multiple activations, a new brand campaign in the fall. We're launching new segments supported by more shelf space in the second half. We're launching new offering for adult collectors and new kids content on Netflix. And you know Barbie well, you follow the story. Barbie has consistently gained global share and continued to strengthen its position as the leader in the dolls category. So very few brands have the cultural relevance as Barbie, and we couldn't be more confident about this incredible franchise.
Well, we know Barbie's done well since the movie, but I want to know what's next in media. I mean, you told me there could be a lot of good things down the pipe. I want to see something from Mattel in the movies.
Yeah, movies is an important part of our entertainment strategy. There's great momentum following the Barbie movie. There are 16 films in various stages of development and pre-production. Just recently, we announced that Masters of the Universe will be released in theaters worldwide on June 5th, 2026, distributed by Amazon MGM. There's a new Monster High movie that we are co-developing with Universal and Academy Award-winning producer and screenwriter Akiva Goldsman. And Matchbox has a great director, Sam Hargraves, that directed Extraction, that we're very excited by. So there's a lot of activity. These are just the recent examples, but 16 movies in total currently being developed and ready for production.
Now, I don't know about this cat in an outfit, but I do know one thing. When I met you multiple times, the one thing I always said to you is, look, could there be a moment where you have so much cash, you fix the balance sheet, you've got these great properties, and it makes it so you are actually vulnerable. Look, you're $722 million. You bought back $100 million worth of stock. But, I mean, at what point does your stock just become so cheap that something does happen?
Well, we believe the stock price does not reflect the success we have had to date, and importantly, the future potential. You know the numbers well. If you just look at some of the key metrics, our top line grew by more than $500 million. This is since the start of our turnaround in 2018. Adjusted gross margin improved by almost 1,000 basis points. Our adjusted EBITDA grew by 7.5 times. And free cash flow went from a negative $325 million to more than $700 million. And of course, we are now investment grade and beyond the financial metrics. Our brands are thriving. We are gaining share in the toy business. We're winning major licenses and are having great momentum in our entertainment strategy, highlighted by the Barbie movie as one obvious showcase with so much more in the works. So we are well positioned to build on this multi-year trajectory and continue to execute our strategy and expect the share price to reflect this over time.
Well, look, your asset-light model, which you've completely turned around, it's definitely the right thing, says to me that, look, if you buyers don't want it, we'll buy it. Why just $100 million? Why not just stand there at 17 and say, listen, we will buy everything?
Well, we've been buying, at this point, over $400 million since we resumed share repurchase last year, which was the first time that this happened in 9 years. We do have still $800 million remaining under our current $1 billion authorization. We expect to continue to do more share repurchase in line with our capital allocation priorities. And this reflects our confidence in our strategy to grow sales, earnings, and free cash flow and create long-term shareholder value.
Okay, now your gross margins indicate that the consumer is pretty robust. You're able to get that full price, but we are starting to see this frugality of the consumer, whether it be going cruise lines instead of going to theme parks, whether it be not taking expensive airlines, whether it be using Amazon Prime Day rather than holding back. Are you seeing a too frugal consumer?
You know, we don't see that. The toy industry actually performed better than anticipated in the first half and was comparable to the prior year period. We still expect the toy industry to decline modestly in 2024, but this is an improvement from our initial outlook at the start of the year. Certain categories are driving this. This is building sets and adult fan and collectors, which bodes well for our strategy. And beyond 2024, we believe that trends will further improve and the industry will return to growth and continue to grow over the long term. The fundamentals of the toy industry are strong. Toys are an important part of consumers' lives, and retailers see the category as a strategic lever. And within this environment, we expect Mattel to continue to gain share and outperform the market this year and next year as well.
Well, look, I share with you, I say, a budding frustration. Cash building, sales good, toy category over and over again. I keep hearing from every retailer is the place to be. But the stock has not done what you and I thought it would do. So let's see what happens. But it does represent a bargain here. Ynon Kreiz, Chairman and CEO of Mattel. Thank you for coming on Mad Money.
Thank you, Jim.
Good to see you. Mad Money's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. It's time for the light round because everybody that's where you take about our calls. You say minutes. How can I tell you about buy, sell, so just regarding the course stock was at time. Step prepared to go for we plan to sell. And then the lightning round is over. Are you ready? Ski deck. Time for the lightning round. Let's start with Harry in my home state of New Jersey. Harry.
Booyah, Mr. Cramer. Thank you
Harry.
so much for taking my call.
I'm glad you're on.
Yeah, I'm interested in this shipping company. It's petroleum products is their thing, and the name of the company is Torm, and the letters are TRMD.
Okay, this is one of those companies that it has a remarkably high dividend yield, and as long as it has that dividend yield, the stock's going to stay up. But when things start going bad, and they always do in this business, that yield's going to start going down, okay? And you are going to say to yourself, why am I still in this stock? So be aware, right now it's still going up, but these things are slopes, and they just get crushed. When that dividend goes down, yield will go down with it. Keep that in mind. That's unusual. Let's go to Merrick in Tennessee. Merrick.
Hey, Cramer, how you doing?
I'm doing well. How about you, Merrick?
I'm doing really well. I just wanted to get your opinion on Train Technologies. I've been researching.
Hard to stop a train. Now, that company's going to report soon, and the stock's been straight up. The ones that have been straight up have been selling off, but believe me, Train is for real, as is Carrier, by the way. And now I'm starting to look at Johnson Controls, a little early, JCI. Let's go to Craig in Texas. Craig.
Hey, what's going on, Kramer, my man? How you feeling today?
I am doing well. How about you?
I'm doing wonderful. I had a question about a stock. It hit an all-time high today, and in addition to that, got a couple upgrades, and I feel like it doesn't get a lot of attention, which is probably good. The stock I'm calling about is SAP.
You know, we had Christian Klein on recently, and the guy was so impressive. But because it's viewed as a German company, people don't want to buy it. This stock is incredible. I think that SAP is not done going higher. Let's go to Jim in Tennessee. Jim.
What about booyah, Mr. Cramer, and a booyah to your staff?
My staff is awesome. Absolutely. What's going on?
Hey, back in January, you took a lightning round call on the stock, and we're going to do some more research on it. The stock was upgraded yesterday. It trades at 85 and change, was upgraded to 130 and has several target prices up to 190. My question is, the stock has missed earning 4 times in a row, but it doesn't get killed every time for some reason. It takes a hit, but not serious hits. The stock is Axiom Therapeutics.
Okay, this is Central Nervous System, CNS. If you can make a breakthrough in CNS, your stock will double. If not, it will just go down. That's a double or nothing stock right there. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, field of streams, why the tech megacaps are in a league of their own. Next.
Some businesses are just plain bad. That's something we keep learning this earnings season, and it's painful to watch it unfold. For example, the content business is one awful business. It's incredible how difficult it is, in part because the companies need to pay fortunes for programming, especially for sports rights, prices that until very recently could be justified by eyeballs. I am not sure they can be justified anymore, because while these rights seem dear to old-line media companies, they seem cheap for the mega-cap techs. Amazon and Alphabet seem willing to bid up all sorts of sports event programming, something that Comcast or Disney or Paramount can't afford. They don't have virtually infinite money. Right now, the media companies we grew up with that need to pay for content are really in a dogfight that perhaps they cannot win. The mega caps are convinced that they should be in content, and they know that. For example, that the NBA can be a draw for all sorts of other options, including retail sales, their own retail sales, as in the case of Amazon. So what do? They bid on a package of games that would have assuredly gone to a Warner Brothers Discovery, which currently has excellent coverage and a fantastic adjacent show, Inside the NBA, starring Charles Barkley. Everyone knows Barkley's amazing, to the point where people watch Inside the NBA even if they don't watch professional basketball. Yeah, it's that compelling. But Amazon wants that package, and what Amazon wants, Amazon gets. Sure, you may have to pay $15 extra per month to watch the NBA on Amazon versus free ad-supported TV. Some would say it's a tax on those who want to watch, including underprivileged people, who will now be pushed to buy sneakers via Amazon's inferential recommendation system. I say the team owners want to be alive with Amazon. There's no going back to the old days, even if Warner Brothers paid enough to match Amazon for its NBA rights. It's just not clear how this battle plays out, but Amazon's got a huge war chest. It can probably preemptively outbid anyone. We know the NFL has been a terrific property for Fox, NBC, and ABC. These networks have always argued that football's a great business for them, and it also gets you to watch their other programming. But Amazon now has the rights to a bunch of games. Netflix has both Christmas Day games, and Alphabet has the NFL Sunday Ticket, which they're finally doing a phenomenal job with after ironing the kinks out. If Apple wanted games for Apple TV Plus, it could bid for whatever's available and win it. The linear TV folk, though, can't compete because their cash generation doesn't come anywhere near the mega caps. Plus, the digital players have a real edge in that they often have content that costs them nothing. If Alphabet's, for instance, YouTube, I mean, it's got tons of programming they get for free. Same with Alphabet's like Reddit and Pinterest. Their users create pretty much all of their content. They have such an advantage over an ESPN, which has to pay a huge amount for everything. Meanwhile, the ads on streaming can be targeted to the most interested consumers, and the ads on ESPN broadcasts are basically a blunderbuss aimed at everything. Another issue, the linear TV guys don't have enough ads, but an outfit like Netflix, they said they have too many ads. What a high-quality problem. Ultimately, I see a universe where Amazon, YouTube, and Apple TV Plus own the world that currently belongs to linear TV, with Pinterest, Netflix, and Reddit being like what we used to call the UHF channels, the higher ones on the dial filled with local and amateur stations. It's the way of the world. The megacaps have too much money to be beaten, as long as they're willing to spend it. I have no idea what happens to the old-line linear TV plays. They need to rethink what content people will pay for. That's where the profits could have to come from, not sports, because in the end, I can see Alphabet, Amazon, and Apple locking up all the pro sports they want at prices the old-line media companies simply can't compete with. As long as the streamers are willing to pay up for the best content, the old-line players will keep being beaten, especially with their own streaming entities, so they find a new way to approach the business. It's too bad. We all grew up on free ad-supported sports. Soon, those days might be over. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and/or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.